Hi, I'm Eric Lanning. I'm a tax attorney with Frost Law. And many other tax professionals that I have spoken with have seen an alarming trend over the past year and a half, which is the proliferation of online investment related. Some of these schemes are sort of colloquially referred to as pig butcher. In general, in this situation, our victim is contacted online, is offered some form of investment opportunity, usually in cryptocurrency. They're induced to make these investments. Sometimes these individuals are induced to withdraw funds from tax qualified accounts like IRAs or 401ks. Once this money is invested, the individuals are shown what is in most cases manufactured investment gain or false gains. Ultimately, when the victim attempts to withdraw funds, their account is locked or frozen. In many cases, they're asked to pay additional penalties, withdrawal penalties, security deposits, or even taxes on the gains in order to make these distributions. But generally, these amounts, when they are paid in, do not allow the individual to make the withdrawal. Ultimately, the account will disappear and the individual has lost their funds, sometimes hundreds of thousands or even millions of dollars. We've seen this guidance, and at Frost Law, we've worked with a lot of clients to help substantiate that loss as a theft loss. Very briefly, as many tax practitioners know, theft losses are not readily deductible in 2025. The Tax Cuts and Jobs Act of 2017 suspended the sort of the generic theft and casualty loss for tax years 2018 through 2025. One smaller category of loss that was not suspended by the TCJA is a loss incurred in a transaction entered into for profit. Notably, the IRS has issued guidance in the past on what are referred to as Ponzi schemes or investment schemes that concludes essentially that the losses in those investment schemes, the Ponzi schemes, are treated as transactions entered into for profit and therefore constitute theft losses that are deductible as ordinary losses. Up until recently, the IRS hasn't given any guidance, however, on the application of those rules to the pig butchering scams or other online investment related scams. But just recently, the IRS issued a Chief Counsel Advice Memorandum, which is an advice memo written by the IRS National Office attorneys. And essentially, in this Chief Counsel Advice Memorandum, the IRS outlined its position on the availability of the theft loss deduction for 5 different varieties of online scams that we see in practice. So in sort of the reverse order of importance, the IRS confirmed that losses from so-called romance scams or kidnapping scams or blackmail type scams are not deductible. In these situations, our victim is induced to send money to perhaps a purported romantic partner or in order to secure the release of a loved one who they're told is in danger. In these situations, the individual is motivated simply by their own desire to further what they believe is a relationship, or in the case of a kidnapping scam, their belief that an individual that they know and love is in danger. In these cases, though, the individual, the victim, does not have any profit motive in what they're doing. Clearly, these are not profit-seeking situations. The IRS has noted, though, that for those types of losses, the impact of the TCJA suspension of theft losses is that these losses do not generally constitute deductible theft losses. However, the IRS looked at 3 other types of scams and generally concluded in each case that in the scams, the victim is motivated with a profit motive. They are involved in, again, a transaction entered into for profit. And as such, the losses related to those scams are potentially deductible as theft losses under that category. Again, the transaction entered into for profit. So first of all, the scam we talked about a little bit ago, the pig butchering scam, is addressed in this memo. And the IRS concluded, consistent with Frost Law's thinking on this issue, that those losses incurred by a victim of a pig butchering scam generally are going to be deductible as losses from a transaction entered into for profit. There are a few interesting observations the IRS makes related to pig butchering scams that I think are worth mentioning. First of all, the IRS concludes or acknowledges that in the situation where an individual is induced to pay additional amounts for taxes or fees, those amounts are also deductible losses. Those are amounts lost in the transaction entered into for profit. Second, the IRS acknowledges that not all pig butchering scams start the same way. Many of them, in fact, start as romantic or social relationships that then evolve, in a sense, into a pig butchering scam. And the IRS acknowledges that once that evolves to a pig butchering scam, the pig butchering analysis would apply. The IRS may be guided through several intermediate steps between the withdrawal from their own investment account and the investment of their funds into the fraudulent platform. The IRS acknowledges these exist and they don't change the overall analysis of the theft loss. And the last kind of interesting observation is that the IRS confirms that these are losses that show up on the Schedule B of the Form 4684. Now, that's meaningful because of another point the IRS makes in the CCA, which is that none of these fraud victims can take advantage of the safe harbor that was established for victims of Ponzi schemes. So for a victim of a Ponzi scheme, there is a safe harbor procedure for deducting the loss. That generally requires, kind of one of the key features of that is that there be a single identified mastermind behind the scheme. With these online scams, we just don't have that. We see many news stories about who might be behind these scams, but there's no sort of centralized figure that can be pointed to. And so that safe harbor is not generally going to be available. However, the IRS acknowledges that this theft loss is shown on the portion of the loss schedule that doesn't relate to the safe harbor. So this is a more confirmation of what we've seen. The two other scams where the IRS concludes that there are potentially deductible theft losses are the compromised account scam and the phishing scam. In the compromised account scam, our victim is contacted by someone purporting to be customer service or fraud detection. They're generally told that their accounts are potentially going to be subject to fraud, and they are told that they need to move their funds to a new safe account. This is generally an account that the scammer has set up, and the victim then will move their funds to this scammer's account, and the money's usually gone at that point. What's important here is that the IRS confirms that although the individual's motive in moving their money from their own account to the scammer's account is more for protecting their assets and not generating new investment, the IRS points out that it's important to look at the entirety of the transaction and understand that if the assets that are being stolen are investment assets where the victim had an initial profit motive in establishing those assets, that profit motive continues through and determines the character of this transaction. So in that case, the IRS confirmed that the theft loss for a theft from a transaction entered into for profit would apply, and that those rules would apply and the deduction is potentially available. The last scenario is the phishing scam, which probably most people are familiar with. In this case, the scammer gains control of either the computer or maybe directly the financial accounts of the victim and then moves the money out of the victim's accounts without the victim requesting a withdrawal or a distribution. So it's really sort of the hand of the scammer reaching into the account and pulling it out. And the IRS made an interesting observation here. They note that under existing law, the victim in that case may not be treated as receiving a taxable distribution of the IRA or qualified plan withdrawal because the victim didn't authorize that withdrawal. They didn't intend to make the withdrawal. And so the IRS says that may not be a taxable event to the individual. However, they note that to the extent that it is a taxable event, and that leaves a little bit of optionality for the victim, I think, the IRS notes that if it is taxable, then that situation would establish a transaction entered into for profit and a potentially deductible theft loss. So it's interesting because the victim in the phishing scam almost really has a choice. They can treat the distribution from an IRA, for example, as taxable to them or potentially taxable, included in taxable income, and then offset that amount with the theft loss deduction. What's probably a simpler option is for them to take the position under existing law that that distribution from the IRA is not taxable in the first instance. It's not included in taxable income because they didn't request it. The scammer requested it and pulled it out. That individual wouldn't have a deduction available, the theft loss deduction, for that amount because it wasn't included in income, but they're already not including it in taxable income. So that's probably a simpler and better result. Overall, we're very pleased with this guidance. It's consistent with the work that we've done with clients and the opinions that we've provided. related to the potential deductibility of these losses. We still potentially see issues in ensuring that taxpayers are meeting the factual requirements of this guidance. And the guidance really doesn't touch on a couple of important issues that we've seen, which is the amount of the deduction overall and what needs to be deducted if the taxpayer has any recoveries. And it doesn't really touch on the timing of the deduction. It's important to note that if you or someone you know has been a victim of one of these scams, or if you're a professional working with someone who is a victim of one of these scams, perhaps a tax preparer or an attorney, and you have any questions about this Chief Counsel Advice Memorandum or our experience in reviewing and substantiating the potential deductibility of these losses, please don't hesitate to contact us. Again, very happy with the guidance that the IRS has provided in this Chief Counsel Advice Memorandum. Certainly happy to answer any questions. I'm Eric Lanning, tax attorney at Frost Law.